That three-digit number attached to your name could be costing you thousands of dollars, and most people were never taught how the system actually works. Today, I'm going to break down exactly what your credit score means, who's tracking it, how lenders use it, and why mastering this number can completely change the way you move financially. And don't forget to do me a quick favor before we get into it. Go ahead and hit that like button, share the video, and subscribe if you haven't subscribed to the channel yet. And walk with me as I go over these 8 weeks of these credit concepts that people do not teach. 80, etc., etc. All right, so look, I want to talk about the yes factor. When you use credit to generate wealth like the elite people do, and believe you me, we are all elite, right? It's just a matter of us getting into that position, utilizing and leveraging our credit in order for us to get into that position. And the myth that a lot of people talk about is credit being the trap for buying things that you cannot afford. It is a myth, but it's not inherently a myth, right? It can be true for some. A lot of people, especially like our people, we tend to purchase things, acquire things that we can't necessarily afford. And when our paycheck don't cut it, we go ahead and we leverage our credit in order to go and attain those things that we want, that we don't necessarily need. And so that, in essence, is absolutely a trap, right? The truth of the matter is, though, credit is leverage. It is using other people's money to actually build your wealth. So we got to get out of the concept of looking at credit as it's an extension of our money. It's not. It don't belong to us. It's other people's money. They call it OPM for a reason. We just use OPM the wrong way. So when we're using other people's money, we don't want to use other people's money to buy us things that we don't need, liabilities and things of that sort, right? We want to use other people's money in order to go ahead and increase our money, our personal wealth. And so the goal is earning the ultimate luxury, a financial system that instantly says yes whenever you need capital. So using credit in order to go ahead and gain more credit and more capital by leveraging the different types of credit that may be afforded to you based on how you use that credit. And so first and foremost, when we talk about the credit score, understand that credit is a trust score. That score shows lenders out the gate whether they can trust you or not, right? So just imagine your profile is decent, but your score is low. Well, the score is an algorithm, and there's certain things that manipulate the score one way or another. Like you can't have an 800 credit score with a poor credit profile. It just doesn't work that way, right? But you can have somewhere in the middle of like high 600s, low 700s, depending on what you have inside of it. But to a lender, to somebody that's viewing your score, when they look at the score, it tells them something out the gate. They're already prejudging you before the profile even come into play. If you actually get in the door of lending opportunities with that lending institution. So the score is a trust factor. It's a reputation between you and the banks that you bank with, the lending institutions that you deal with. So how you treat that relationship will determine how your score will look. And the reason why this is important is because people get into relationships, and I know this is true for all of you. You want to have decent relationships, right? Nobody want to have a bad relationship. We want to have good relationships with people. And so if we meet people and we hear that they typically have bad relationships with others, we really don't want to relate with that person. Am I right or am I right? Right. So if the bank is looking at your score and your score is not scoring good, it's showing them that you don't really have good relations, right? But if you're in a certain bracket, they may be willing to give you a chance, and that's where the report come into play. Let's see what's going on. Let's see what happened. Let's see how they handled the credit that they were given. So the one thing that I want you guys to do first and foremost is to forget the math, because at its core, a credit score is simply a measure of your reputation. Have you made your payments? Have you paid them on time? How much of the credit are you actually using? How much credit are you applying for? And what does your credit mix look like? And how long have you been in this credit bag? How long you been in your credit bag, right? All of those things factor into you and how likely you are to be eligible for the things that they have to lend you, right? So history is one of the biggest factors when it comes to your credit. The reason being, right, is because I got you, Sakin. I see you. I come to you 1 second. History is one of the biggest factors because even though payment history is 35% of your score and utilization is 30% of your score, and your history is one of the lowest percentages that factor into your score, your credit score, is one of the most important when it comes to lenders, because this is what they can actually look at to be able to determine if you are lend worthy. So you may have 100% payment history, but if you only been using credit for 6 months, like we don't have time to really like study you to assess what you've been able to do, as opposed to somebody that has been having credit for 10 years and they may have missed a payment or so, but otherwise has been completely good. We know that this person can handle credit over an extended period of time. And so when we think about that, you got to understand like how loans work, right? So when you get loans and you have an installments, they're typically about anywhere from 24 months, right? 12 to 24 to 36, depending on the length of the loan that you acquire. Why that's important is because why would I want to give you a loan for 2 years or more when you only been leveraging your credit for 6 months and I have no way of knowing if you're going to default on that or not? Where I can see somebody else have had 10 years worth of history and they may have had a slip up. We can understand that because we know how credit works, right? As a lending institution, a person might default. But if a person, and this is the crazy part, y'all, if a person missed a payment, but otherwise have been perfect when it comes to their payment history, I, as a lender, could overlook that because when you missed the payment, your score went down. So you may have got that loan and your score may have been around 700, 740, wherever the case may be. You may have missed that payment and it knocked you down to about a 680. You're still eligible to acquire a loan, right? But me as a lender, I know you are still a 740 caliber person. The only reason you have a 680 score is because you missed that one payment. But I'm looking at your history and I see everything that you've been doing and you've been making your payments on time, all the time, every time. You might be very attractive to me. Why? Because I know that you're a trustworthy person, for one. For two, I'm getting you at a good deal because my whole goal is to make money off of my lending products. So if your credit score went down a little bit, I can go up a little bit and charge you a higher interest rate than I would have if you were still at 740. So you're still a 740 caliber person, but I get to charge you like a 680 person, right? If that makes sense. Let me know if y'all got it in the chat. And I'll pause on that. Sakin, what's your question? All right, let me know when you're ready. All right, so the ultimate question is, if I lend you this, do I trust you to give it back? That's all we want to know at the end of the day. That's for us as people, and that's as lenders and lending institutions. If your best friend want to borrow some money from you, the first thing you want to do is know, when can you pay it back? How are you going to pay it back? No, I couldn't hear you. I didn't hear you, King. Right? So your 3-digit score equals your financial reputation. We have to guard that. We have to guard our financial reputation because we don't want to be seen in the eyes of the lenders as somebody who is unworthy, somebody who has bad relationships, somebody who cannot afford to pay or leverage or utilize their credit, right? Now, why is this important? Well, I'm talking about history. When typically when people talk about or teach about credit, they don't really teach the history component, right? They don't treat that as a big component of credit, but it is very important. And when it comes to history, I want you guys to think about the 3 bureaus that store our data, that collect our data, right? And I'm calling these the 3 librarians. They keep all of this information, right? They're like librarians. They want to keep and display your personal data when it comes to your credit. But they're not the judges, though. They don't decide if you get a loan or if your applications get approved, right? All they doing is furnishing data. That's it. That's all. So make no mistake about it. They're not as powerful as many people believe that they are. And the reason why we believe that they are powerful is because the way in which they can affect the way we can get approved for a loan or any application that we need to get approved for, right? Just based on the lenders going to them for the information that they have. So these are librarians, right? I'm going to go get a book on Tay. Let me see how he has been performing when it comes to credit. And they go and they look at this information and then they determine, but these people have absolutely no say so in whether you get approved or denied. They're simply furnishing data, right? So I want you guys to understand this. What is their goal as data furnishers? All it is to continue to have data that they can show to these lenders. Why? Because these lenders will pay them. Because if I am able to charge somebody of a 740 caliber, interest rates at a 680 or below, right? I want to be able to do that so that I can make more money and save more money. How would I know that this person is worthy or eligible or any of that without the data? I have to go see the people who have the data. So by law, these people are able to collect data, right? But there's certain laws that they must abide by. However, this is how they make their money, by reporting all of the things that you have in your credit profile, the good, the bad, and especially, preferably, the ugly. They want to be able to furnish the ugly, the negatives, the bad things on your credit, because these lenders love to make money as well. So if they report negative and the lenders are appreciative of that negative that they're reporting, and they get more money for those accounts because lenders can charge more money for people that have that negative information on their profile. Do you not think it'd be in their best interest to continue to furnish that negative information? Of course it would, right? So these people are just simply record keepers. They simply collect the data, they organize it, and then they hand the files over to the lenders. They are not for profit, or they LLC and corporations and stuff like that. They are not federal government. And this is the rule of the library. The librarians can do and they can make mistakes. It's your job. It is your job to check their work. So if they put your book on the wrong shelf, it's displayed wrongly, it's not on them. It's on you to make sure that you get categorized correctly, right? You guys got that so far?
Can you hear me now?
I can hear you clearly now.
All right. So my question earlier, because you were saying you can have like a decent profile, but if your credit score not adding up to that too, like they not even really going to take a peek of it. Are you saying all banks, period? Or because I know when it comes to credit unions, we love to talk about they give out the bag because you can't have like you can have a little bit of something going on. You don't have the highest credit score going on, but they'll still throw you something. Like they'll still throw you like a decent amount. So when you said what you said, you was talking about like banks and lenders, period, or you just talking about like most of them and like not including credit unions too.
No, I'm talking about most of them, credit unions as well, right? But the thing about credit unions are they relationship based. So that's the beautiful part about it, is that they overlook a lot of the things that traditional banks don't look, because they are exceptionally greedy. They want their money the best way they can get it. So they get their money by squeezing the consumers, right? Putting you in a position to where you can only get certain products and stuff like that. Whereas credit unions, they reinvest their profits into their customers, right? Which is us, which is consumers. And so they do that by giving us better terms, better rates and stuff like that. So they're able to actually give us or lend us more. And they do that based on relationships. And so that's why I'm talking about history as being so important. But even then, though, you still have credit unions that are like, that they look at you a certain way, especially when you have a certain score. But if you've been banking with them, you've been dealing with them for a while, they tend to overlook everything else because most of them have internal scores. They don't really rely on what these librarians are saying. At the end of the day, they're like, nah, this person been banking with us We can see what's going on. This is direct deposit. This person is making deposits every week. This person is paying this bill on time. We can go ahead and lend to this person.
Got you. Just wanted to clear that up a little bit. I'm pretty sure there's some credit unions too. They don't even care about that you carry you in the check systems too. But there are some banks that are a little bit more stricter than others. But I just wanted to clear up on that part. Okay, I got
Yeah,
you.
you 100% right. Just like Navy Federal. Navy Federal is a second chance bank for those who don't know, right? They don't. If you're in check system, you can still get a Navy Federal, and it's a lot of credit unions that are like that as well.
And some banks too that let you get like a bank account too, like PNC. I think they got a second chance account too.
Yeah, PNC
Yep.
does. Exactly. All right, y'all. So let's go from index cards to data centers, right? And so this is the evolution of the bureaus. So back in the day, when they first started, 1899, Equifax, look, they used to collect and they used to store data on index cards, y'all. Look how far we come. So the founders, they was founded as a retail credit company. They started with welcome wagons, taking handwritten notes on neighbors, home furnishings, and character, right? How's your character? What are you living like and stuff like that? They wrote it on index cards and they kept it in files and cabinets and stuff like that. And TransUnion in 1969, there was a railroad car leasing company that acquired a bureau storing 3.6 million paper index cards stuffed into 400 filing cabinets, right? So you can imagine how many errors was happening back then and how many errors are still happening now, right? So because today you got a digital web of trillions and trillions of data points that are calculated in milliseconds by advanced algorithms. So we have to be able to beat the algorithm, y'all. So we have a better chance of combating all of the stuff that is going down, because back then when stuff being written down, it's a lot harder to dispute, right? It's like I sat there and I wrote this down. I have this on file. It's sitting right here. It's not going to go anywhere, right? So when it comes to these algorithms and all these different data centers and stuff like that, things happen. Things can get hacked. Things can get missing. Things can disappear and stuff like that. So it's a lot easier for us to correct our credit, right? Now let's get into the FICO recipe. The 5 pillars of your 3-digit score, and we all know these, right? And so the creator of the FICO score is Bill Fair. He was an engineer, and then Earl Isaac was a mathematician. These two people, they came together and they created the FICO score. They wrote the automated scoring recipe, and this came about in the 1950s. That's not too long ago, right? Now, 35% payment history, 30% for your utilization, 10% for your credit mix, 10% for your new credit, and 15% for your length of history. Now, this is the first pillar. This is the number one factor that affects your score, is your payment history. So basically what it is saying is that your word is your bond, right? And if you've been around for a while, then you know that back in the day, that's what it really used to be like. This is not just a cute saying that people use from time to time. Back then, your credit score was basically your word, your ability to pay back based on you keeping your word, right? That was once upon a time in existence. And so the heaviest weight that lenders believe history dictates the future. This is the most critical piece of the puzzle. The goal is for you to have 100% on-time payments, because one late payment is a broken promise that's going to leave a scar on your report. Now, it's a black eye. No matter what happened, you get that late payment, everybody else is going to want to know what this late payment was for. How did this happen? Why would I lend to you? You had late payments. Why did you not make your payment when you were supposed to make your payment? You didn't fulfill the contract, or you breached the contract, or whatever the case may be, right? It's going to stick out like a sore thumb, because unfortunately, when lenders want to lend to you, the first thing that they're going to look at is what's negative on your report before they consider what's positive on your report, right? They want to see the history, like how much of a threat that you are, how worthy you are when it comes to your credit. So that is the warning. Paying off a card with a recent late payment, it does not fix your damage, right? It take a year to 2 years of positive payment history to go ahead and correct that. So payoffs do not erase your late history. So the key is to avoid ever getting that late payment on your credit in the first place, because it can affect you for up to 2 years. Pillar number 2 is utilization. And this is your temptation test, right? They want to know. They want to know. Why we look at it is, how much credit are we actually using? Are we going over 30%? Are we doing it? Are we doing that? But they want to know, how tempted are you to use credit, right? And so that's why sometimes you may hear people say that lenders want to see that you have credit, but you don't need credit, right? Or you don't want to use credit and things of that nature. So these people give you credit. This utilization is really a temptation test. How much of it are you actually using? So the question is, if a bank hands you 10,000, are you desperate enough to spend it all immediately, right? They're going to put you in a high risk category if you constantly going up on that utilization. The standard is never to use more than 30% of your available credit limits. Now, the elite target, though, is to keep your balance under 9% so that you can achieve scoring mastery and prove absolute financial self-control, right? It's a temptation test. So you want to stay below 10% and you want to stay above 0%. So anywhere between 1 and 9% is ideally where you want to be, right? You never really want to pay off your cards completely. You don't want to have a zero balance reporting, because credit is to be leveraged. You want to show that you're using it, but you're not using much, because not only are you trying to manipulate the system, you are actually like triggering the algorithm, right? Not a human person is looking at how much you're actually using. So that algorithm, you want to continue to have it report that you're using some of your credit, right? A little bit of it. Now, pillar number 3, length of history, and the one I really want to put emphasis on today is that wisdom actually grows with age, right? So the more history you have, the more you learn about credit and the more lendworthy you become. You may have had a late payment, but you have been able to understand how that late payment affects you once you've been in this game for a while. So you may have had credit, you may have a late payment 2 years ago, and you may have a 10-year credit history, right? Well, for you, you have an understanding of what's going on with credit and how it works. So lenders love that. You're more trustworthy than somebody that don't know no better. Like they ain't never had a, like, it's like when criminals get that slap on the wrist, right? It's like you ain't never did no time. You ain't learned your lesson. So people that has been through this, who've been around for a while, typically learn a lesson. And for those who didn't have any negatives and they've been around for a while, then these people care more about their credit, right? This is how the lenders see them. Like they care a lot more about their credit. They're less likely to make a mistake. Danisha, you got a question?
Yes, sir. When you was talking about utilization and making sure that something is reporting just a little bit, my
Mhm.
question was specifically about all these cards. So I have several cards and I try to keep them all zeroed out, but it sounds like I just want to make sure I understand correctly. As long as my total utilization is reporting low, I don't necessarily need to be using every single card. Is that right?
Yes, and it depends on what your credit goals is, right? Okay, so overall credit utilization is what matters ultimately. Like you never want to have your overall utilization above 30%, but each
Mhm.
individual card, you also want to have it below 30% as well. So it's just like if I have a $50,000 card and then I keep it under 30%, but I got $1,000 card and it's at 80%, right? That's bad for that one card because I look high risk to that one lender, right? And it
Mhm.
and it shows a it shows like a slight irresponsibility, right? Because it's like a person that would know better would do better. Like, why would you maximize so much money on this card right here and use your credit in that way? It's like a misuse of credit. So you're doing the right thing by keeping all your balances down, but you want to have them not reporting at zero. So if you can, like whatever you're using or whatever you're doing, if you have any subscriptions that are low, you getting gas or whatever the case may be, just use that card and then pay it off, or just leave a couple of dollars on there that they report, so that way it shows that you using your card. Because if you have them reporting at zero for too long, they'll shut the card down because they're not making no money off you. And that takes a while. Those typically like around 6 months. But yeah, you absolutely want to be reporting some type of a balance.
Okay, I know that I did start trying to use the cards, and I'll get an alert on my credit report that says dormant activity or dormant card has identified activity or something like that. But yeah, I typically use this one card with the biggest limit, and I keep it below 4%. But yeah, I just need to stretch it out, like you said, spread it out a little bit. All right, thank you.
You're welcome. Yeah, you definitely don't want them cards going dormant. All right, so the concept is that lenders inherently trust older seasoned accounts over branded new ones. Time equals stability. And the common mistake is closing your oldest credit card because you no longer use it, right? Or allowing these people to close the card because they feel like you don't use it or you don't need it. The elite strategy is to keep your oldest accounts open and active to permanently anchor the age of your credit profile. Now, the reason why this is extremely important, and this is the part that most people never really talk about, is because your history is calculated by all of your accounts, right? The percentage of all of your accounts. So, for example, if I have a 10-year-old account and then I have a 1-year-old account and I put these together, then I have like about a 5-year history on average, right? So that would mean that if I have a 1-year account and a 10-year account and I have a 5-year history, but if I close that 10-year account, now I only have 1 year worth of history because I lost all of that credit age. This is bad because not only did I lose all of that history, moving forward, I'm going to want to get more credit. I always want to be able to add accounts. So now from 1 year, every time I add an account, it's bringing my balance down. So now if I got a 1-year account and then I went and applied for a new card, now my history went down to 6 months as opposed to 1 year, right? So we want to hold on to those older accounts because of the new accounts that we will be able to add in the future is going to bring down our overall history. That makes sense, y'all? Now, and this is like one of the most unattractive parts when it comes to credit, right? We'll talk about the credit mix. Credit mix don't really get thrown around out there and stuff like that. But the reality is that lenders want to be able to see that you can handle different types of credit, not just a credit card. It's easy for somebody to go ahead and get one credit card, put it on auto pay. You got a paycheck coming in, you can handle it, and it's paying your bills every single month. A person with that can have a 700 credit score, right? But it could be a thin profile. It doesn't show all it shows that you can just have a credit card, right? But if you add on an auto loan, you can do the same thing. You can put it on auto pay. It can pay the bills every single month. No default there, but you're showing that you're able to balance between the two. I could pay this off. I could pay my auto loan off. And then if you add something else like a mortgage or an installment loan, that's somebody that lend to you, it's showing you got a mix of different things that you can make payments on. You're versatile when it comes to your credit, right? So the concept is basically, can you handle entirely different types of financial responsibilities at the exact same time? Because installment loans, how those work is that you have a amount that you get that you borrow, and then you have to pay it back a fixed amount every single month. But a credit card, that payment that you have to make is revolving, so it can change, right? You can add more debt to the credit card, or you can add less to the credit card. But when it comes to that loan, you can't really add more debt to it. Like the loan is the loan. Like whatever they granted you, whatever they lended you at the beginning, is going to stay the same. The payments are fixed. We're going to pay those payments off every single time, every single month. And if you default on that payment, then you defaulted on the payment that was set in stone. Whereas a credit card, like your payment may be $25 a month. And then if you start maxing out that card, you have to pay more per month. You might have to start paying $35 per month, right? And auto loan is somewhat similar of the same, like an installment loan as well, right? You typically got the same payment every single month unless you go get refinanced and so on and so forth. So revolving credit cards are credit cards. They have flexible payments and they have variable utilization. So the utilization changes because a credit card gets affected, your overall utilization get affected by another credit card that you add to the picture, right? Whereas a loan, an auto loan is a lot different. It doesn't affect your utilization. However, it affects your auto category when it comes to your credit. And lenders are not looking to go ahead and give you auto loans after auto loan at the auto loan because how many cars do you need personally, right? Or how many homes do you need personally? That's why we have debt to income ratios and stuff like that. When it comes to mortgages and everything, it heavily affects you. So your installment loans will be your mortgages, your auto loans, your fixed monthly payments that you have to pay over time. And your strategy would be to have a synchronized blend of both, which will prove high level financial coordination to that algorithm, right? You want to trigger that algorithm. So you don't want the algorithm just to see that you have revolving credit every single month. You also have revolving as well as installment, right? Every single month. All right, cool. So pillar 5 is new credit. And new credit is those hard inquiries. When we apply for new credit, we get those hard inquiries. You want to avoid those because you will start to look desperate. And that alone is a red flag. So it only affects 10% of your credit score, right? But it's a heavy weighted metric when it comes to lending. Because just like when you go to your friends and you always asking for money, you always asking for money. Now your friends is talking about you. Hey, so-and-so came and asked me, can they borrow this money? Oh, they asked you too. Yeah, they asked me too. Oh, that's crazy. This person always begging, right? So now nobody really want to lend to you. It's the same thing when it comes to these lending institutions. When you have these hard inquiries, they can see them on your profile. Like, oh, he want to come borrow something from me. She asking for this loan right here. I just seen that last week. You just like, what are you trying to do? You already been denied over there. Now you got denied over there. Now you want to come see me? Like, you look real thirsty, right? So we want to avoid those things by all costs, and we want to keep those clean on our report. We don't want to look desperate. So the concept is, if you asking for too much money from too many different people all at once, it looks inherently suspicious. Like, it really looks suspicious. What is this person up to? This person look like they want to get my money and run away from me. We want to avoid that. And then the impact is that every hard inquiry, it causes a temporary dip in your score that'll last up to 12 months. Now, let me say this. When you get a hard inquiry, it's not a big dip that's going to happen to your score. You're going to typically lose like maybe 1 to 2, maybe 3 points for a hard inquiry, right? It's not going to tank you like a late payment would hit you for 60 to 100 points. It's only going to be 1, 2, or 3 points. However, those things can last on your report for up to 24 months. Well, it will last 24 months unless you get it removed, right? So after about 12 months, that 1 or 2, 3 points, you'll get those back. You never would even really notice it for real unless you're like a chronic score checker. But for 24 months, that thing will stay on your report like a black eye, and lenders will be able to see those, right? We want to avoid that as much as possible. So your strategy will be to play it cool and only apply for new credit when you absolutely need it or you have a strategic purpose. All right, now, so think about that, and I really want y'all to consider that, because people, when they're going after credit, especially when they're new in the credit space, they want to get as much credit as they could potentially get. And there's no real goals on why they want to access this credit, right? So we get credit and we end up falling into that trap that I spoke about in the beginning of the class, of people just getting credit so that they can go ahead and buy things that they want but not necessarily need. We really, really do not want to fall in that trap, right? So we want to have a strategic goal about what we're getting our credit for, what we're going to do with it, how we're going to utilize it. So that way we can make the best out of it. We can leverage it and use that to go ahead and increase our credit bag. Now, this is the math of mastery. This is why your score is worth, let's say, 43,000 in cash, right? So here's the scenario. You got $200,000, 30-year mortgage, right? If you got a low score, your interest rate could be about 5% or more, right? If you got a high score, your interest rate will be about 4%. And the total interest that you pay over the length of that loan with the low score would be about $186,000 as opposed to $143,000 if you had a high score. Notice I said score. High score versus a low score. Your score will put you in certain buckets, right? They call it credit buckets. So based on your overall algorithm and where your score sits at, you can be categorized or tiered in certain buckets. We call it bucketing, right? Now, if you look at the interest rate it's only a 1% difference. So for a person that don't know any better, you're like, man, I got 5%, and this person over here got 4%. You don't understand how that's $43,000 of difference that you're saving just based on 1% alone. So just imagine if it was 6%. Do you be looking at $86,000 in difference that you will pay? And that's based on your credit score, right? So a high credit score literally keeps, on average, $43,000 in your pocket instead of in the bank's pocket. This is money that we need to avoid just giving away, right? We're just giving money away on interest. Interest eats us up, and it buries us alive. That's why it's so hard for people that once they get in debt, it's so hard to get out of debt. It's all about interest. And if we don't know, you have an invisible barrier, right? It's not just about loans anymore, right? We hearing it all over the internet. People are talking about credit, and the goal is for them to want to go ahead and get loans. They're going after these different loans and stuff like that. It's really not about that no more. Your employers, they can actually use your credit check to gauge your character and responsibility before they hire you, right? Has anybody ever had the employer pull their credit? Or have anybody heard that an employer will pull your credit when considering hiring you? Danisha said, yep. Yep. Dominique said, yep. And that's a fact, right? That's a fact. So when I say that your credit report is about your reputation, right? It's not necessarily your reputation when it comes to these banks and these lending institutions. It's your reputation, period. How do you look in the world? Not only your finance, like this is your adult report card. It speaks of who you are as a person. If you're a person that's going around defaulting on your loans and you got a poor credit score, not only the lenders, not only the employers, not only that, like your peers would even look at you like, damn, 400 credit score, like, and judge you based on that, right? Even if they don't even know about credit, they don't even understand how credit works. Just, damn, you got a 500 credit score, right? So these are the things that you need to consider, like when you are not even applying for credit, just in general and life in general, because these are the things that can set you back. Like you got to take responsibility in your adult life, because at the end of the day, you absolutely need credit. There's no way around it. Like cash is king. I would always say that cash is king. Like I'm not one of these people that's going to tell you that credit is king. That's a lie. That is a bold-faced lie. Cash is king. Credit is queen, right? You need both. You need both. Credit can get you indoors that cash simply can't get you in. And the opposite is also true. But one thing for sure, two things for certain is that credit is going to get capped off, right? It's going to get capped off. Once you get so much credit, it's like it's not really much more credit that you can get. But when it comes to cash, you got an unlimited bag, right? You can keep running it up if you got the capability to do that. The difference is that you're very limited when it comes to using your credit in order to convert it into cash, right? Because you can use your cash and always get access to more credit. And this is the game that we play when we're trying to crawl our way up, right? We use other people's money if we don't have it ourselves in order to build relationship with the banks and other lending institutions so that we can get access to more capital, invest the capital, and then go get access to more capital. Well, if you have the cash, I can go ahead and put my money into different accounts and just let that money season. All right. I can put 10,000 here in this bank, in this bank, in that bank, in that bank, let it season, loan against it, get a product for them, get high limit credit cards from them. But if I don't have cash, I cannot do that. I have to sit there and play the loan game, build my credit up, try to get a loan, use that loan if I'm smart to put that money into these banks, let it season, and then go ahead and keep increasing my credit that way, right? Still in that one, coach, just letting me know, oh, yeah, it's yours. This is ours. This is ours, man. If you in the room, this is ours. And so you got insurance companies. They actively charge higher premiums if your score suggests that you are high risk. Did anybody not know that? Me know in the chat. Did you know that? Did you know that you have an auto score that affects your auto rating? You have a mortgage score, like the FICO score. The number that you see is not just based on one score. Like you have other factors that go into the score. Yeah, for sure. And landlords can deny apartment applications entirely based on your financial history as well. So now you see that my credit can affect me, not just getting the loan, but it can affect my livelihood, where I'm able to live at, what I'm able to drive, where I'm able to even work at. So a prestigious company can deny my application just based on me having bad credit. Like, it's like, man, if y'all give me a job and y'all let me work for y'all, I could potentially, pay my bills and get a better car or get a better house. But the system is not designed for you to win. It's designed to keep you at a certain place, right? So be mindful of that if that's how important credit actually is. So the reality, y'all, is that your score is the invisible passport required to you to navigate modern life. And this is exactly why when it comes to credit cards, you have premium cards that give you things like reward points, travel points, bonuses, cashback, and things of that nature, right? We can't get those with those subpar cards. Only thing we get with those is an annual fee. We don't want to pay those annual fee. Another way to keep us down. And so this is your legal shield. And this is the 100% true standard, right? So your armor, it has to be the Fair Credit Reporting Act that got passed in the 1970s or in 1970. And that's your federal shield against those bureaus, those librarians, those people that are furnishing your data, because they don't care if it's accurate or not. They don't care. They just want to be able to furnish it because they're getting paid for it. They don't get paid to report your information accurately, right? I need y'all to hear me on that. The bureaus do not get paid to report your information accurately. They get paid to report your information, period. And if it's negative, they're going to get paid better, right? There's a law that states that they must report it accurately. But who gets to say if they're reporting it accurately or not? Nobody's going to go and check that on your behalf as a consumer. You have to be diligent with what's being reported on your credit report, because you are the one that's responsible of challenging that, correcting that, and making sure that the things that are being reported on your behalf are accurate. That's why we have laws like the FCRA, right? That's why we're able to remove anything from a credit report, y'all. And so your standard is credit reporting is not allowed to be mostly right, right? The law demands absolute 100% true. And I'm going to repeat, this is why we're able to get anything removed from a credit report. So yes, that may have been my debt. Yes, I took out that loan. Yes, I may have defaulted on that, but no, that wasn't the amount. Get that off my credit report, please. Yes, that was my loan. Yes, I defaulted on that loan, didn't pay my bill. Yes, you have the correct amount, but no, that's not the date that I defaulted. Can you remove that, please? It's inaccurate, right? So these are the things that we have to leverage. There's so many ways, because at the end of the day, the credit report is your report. And you have the right for them not to report anything wrong. Anything wrong. You off by a penny, I need that fixed. I need you to get it fixed. And that is your power. If an item on your report is inaccurate, incomplete, or cannot be fully verified, it must be legally deleted. Legally. So you got to go on your treasure hunt, right? Access your free master file. You can get that from annualcreditreport.com. Now, what I will say is annualcreditreport.com will allow you to get a free credit report every single week. It usually be once a month, so like 12 a year or once a year, something like that. Now you can get every week, right? But know that the report that they give you doesn't have a score. It doesn't have a score. So you can't look at the score and determine like, oh, I'm decent, I'm good, I'm bad, or whatever the case may be. You have to go in there and look and see what's actually inside that credit report. And so step one is that you cannot fix a machine if you cannot see the gears, how it's operating. And your two is that under the FACT Act, you are legally entitled to a free report every 12 months. Legally entitled every 12 months, right? But again, you can go and get one every single week, I believe it is, from Annual Credit Report now. And your mission is to pull your master files from all three librarians and hunt for the discrepancies that are holding your score down, right? They're going to have some discrepancies. Then people ain't reporting accurately. That's just not what they're doing. Now, here's your foundation. You want to build a house of credit that actually lasts, right? So for first of all, you have to protect your identity, monitor your reports like a hawk, right? Have your alerts set up and everything like that. And in order for you to do that is that you have to call and you have to get everything that's on your credit report reported correctly when it comes to your identity. You have one name, one social, right? One social security, et cetera, et cetera. One address, right? You don't live at multiple places. Even if you do, don't allow them to report those. They only need to report one address. So we get all of those things cleaned up and we watch those things like a hawk. And then number two is you have to honor your word, y'all. Like we have to be responsible. We have to make sure that we're paying our payments. So again, when I say be strategic about the credit that you're going after, meaning don't just go after credit for the sake of going after credit and getting whatever card that you can use, but also understanding that you get in this car in order to advance your situation, right? Not to go ahead and buy a new Birkin bag or a new Balenciaga or a new whatever it is that you have like, so you're going to stun on your friends that don't matter, right? So be strategic and understand that. So that way, you know, like I'm not going to charge my card on something that I can't afford. So I don't miss a payment, that I can maintain 100% on time payments without exception. And then you have to master your temptation. That's that utilization. Keep it locked under the elite zone, which is under 9% if you can stand it, right? Under 90%, because believe it or not, you're being judged by anything over than that. Even if you're under 30%, they're still looking at you like, you still have a potential risk, right? And if you over 30%, like you out of there, forget about it. They're not going to look out for you. They're not giving you nothing. You ain't getting credit limit increases. You ain't getting none of that, right? So you want to be able to stay in this elite area of under 9%. Now, you want to be able to leverage wisely. Use the bank's money to build wealth, not to buy liabilities. We want to buy assets. So one of the reasons why I said that we want to keep a balanced reporting every single month, because to lenders, it's looking like you're using your credit every single month, right? You're using and leveraging credit, and somebody is getting some type of payment for that, right? Now, if you are reporting only 1% every single month, nobody is able to really determine on the outside looking in how much of that credit that you use. They only able to determine that you use the credit and that you paid it back, and that when you paid it back, it reported as 1%, right? So like if I got $100 worth of credit on a credit card and I use $100 worth of my credit, and then before my credit report, I'll pay off $99, it's going to report 1%, right? So even if I go in there and I use $50 and I pay off $49, it's going to report 1%. If I use $10 and I'll pay off $9, it's going to report 1%. Nobody on the outside looking in is going to be able to determine or be able to tell how much credit I'm actually using, only that I'm using the credit. If it reports every single month at 0, they're not really able to see that, okay, this person paid off his account in full. Like he used the whole 100, but paid it back the whole 100 in full, right? They're not being able to really make those determinations. All they're able to see is like, oh, it reported this way, it reported this way, it reported this way every single month. But in order for it to be reporting at 1%, that means you had to have used it. You had to have used it, because when you use your credit, you got a monthly bill you got to pay. So if it's at 0, then the next month you don't got to pay nothing. You got to pay 0. So it can just report at 0, 0, 0. But in order for it to report at 1%, you have to have used the credit. All right. So that's the code. Y'all got the code. All y'all got to do is go ahead and crack that vote. All right, y'all. We got any feedback, any questions about this credit thing? I just wanted to give y'all a quick view of credit from a different perspective. Nothing that you guys don't know, I haven't heard, but just getting you guys to look at credit in a different way, in a different light, right? So that we can begin to understand it even better. But having said that, do we got any questions? Anything that y'all want to know about a little bit more, go deeper in, go in depth in? Are y'all good? Y'all good? We got it. Put good in the chat. And I'm going to let you guys go ahead and have the remainder of your Saturday. Awesome. Oh, one of the things that, okay, got it. Cool. Appreciate y'all. Thank y'all for pulling up. So what I'm going to be doing is I'm going to be breaking down credit like these next couple of weeks inside of the mentorship is I'm going to be going over credit more because it's an absolute necessity, right? And we need to know more about this stuff. We always hear about, oh, they don't teach that in school. Well, we got to learn it where they teach it at, right? And not only that, we got to apply it. And then we got to go ahead and take the initiative to teach our kids this stuff as well, knowing that they don't learn this in school. So it's our responsibility to learn this and to educate our youth and to go ahead and put this out there, right? It's too much going on in the world of credit that we don't know about, that we need to know about, we should know about, right? And we should be leveraging this information to go ahead and further our knowledge and increase our position, y'all. So this is like week 1 of a section that I'm gonna be doing. I'm gonna be doing like at least 8 weeks on credit, going into depth, but I just want to make sure that we all understand this part right here, the basics. This is simply the basics, right? Yes, cash is king, credit is queen, right? People don't like to admit it. Some people just like controversy, right? That's just like the credit versus debit. People like controversy, right? We know it's better to use. It's crazy because even though cash is king and credit is queen, meaning cash is better than credit, when it comes to actual physical cards, it's much better, obviously, to use your credit card over your debit card, right? Like the cash versus credit don't even come into factor when it comes to credit versus debit because of the points and the rewards and bonuses and stuff like that, cash back we can get from using our credit cards, and we get absolutely none of that when we're using our debit card. And if somebody get a hold of our debit card and they use our money, it's going to be hard to get that money back from lending institutions, right? Whether when it comes to credit, we'll be able to get that back ASAP. All right, y'all. Well, I'm gonna go ahead and head out. I hope that y'all have a beautiful, blessed day. Enjoy the remainder of your Saturday, and I will catch y'all on the next one. Peace out.